Hi, my name is Eddie Blanco. I'm the broker of Stratwell, a local real estate brokerage here in South Florida. And today I'm going to talk about mortgage rates, what causes mortgage rates to go up and down on a macro level, and also tips as it relates to you and what you can do to secure the best mortgage rate possible. Whether you are a first-time home buyer or if you own real estate and considering refinancing and when rates may go up or down, I encourage you to stay tuned and listen to this video. If you've watched videos before from us and haven't had an opportunity to subscribe, I encourage you to go ahead and take a moment to subscribe. Share this video with friends and family if you like the content and like the video. And of course, if you have any questions or have some comments, please use the comment section and comment below. Let's first talk about the macro, right? So just recently, the Fed increased mortgage rates by 75 basis points. That's 0.75%, right? 0.75 of 1%. So that is a substantial increase, the largest increase we've seen in many, many years. The reason the Fed is raising the interest rates is because they want to slow down the economy a little bit to curb inflation. If money costs more to borrow, people will spend less. If they spend less, it will slow the economy down, hopefully to edge off some of the inflation. That's a high-level conversation about how rates are affected. Now, the Fed rate is not directly correlated to mortgage rates. However, it does impact over time. It does impact that. What is directly correlated to the mortgage rates? Well, that's the bond market. And the bond market, usually, as it goes up, interest rates go up. The bond market is affected by the stock market too. So if the stock market's doing poorly, investors will move their money from the stock market and put it into the bond market. They're going to get less return, but it's a long-term, safer investment. A bond market includes mortgage securities. Mortgage securities are 30-year mortgages. You can borrow. These investment groups buy mortgages because they know that they have it secured against real estate and they're going to get a steady rate of return every year. And that is why investors invest in mortgages. And so as the demand for bonds go up, interest rates will go up. And that's just how that market affects it is. But you and I have no control over the Fed rate, the bond market, the stock market. So what are we to do if we are just regular people looking to get the best interest rate? So let's talk about that. Let's talk about your individual loan as a homeowner or a future homeowner. And let's talk about what are some of the things to consider when trying to get the best rate possible. The first is, who are you going to borrow the money from? Who is the mortgage originator that's going to originate that mortgage? So you have companies that are online-based companies that have lower cost overhead, that give tech service, which is not so much hand-holding. So they generally can charge less because they have less overhead. However, usually that comes at a cost to you as a borrower. You got forms to fill out, all this online stuff. You have no one to really guide you through it. You're kind of on your own there online. You have an advisor somewhere in some state, somewhere far, far away from you, who really doesn't know your local market and who you don't have a face-to-face relationship with. So generally you get a lower rate, but you get a little bit less service. However, you can borrow the money from your local bank, where the rate might be a little higher, but you're getting that handhold service. You're getting right to the table, eye to eye, help you fill out the paperwork, help you handhold you, drop off the documents at their office, that kind of stuff, which is you're going to pay a premium for, but that extra premium may be worth it to you. So that's the first thing. Another thing to consider is, as a big picture, is think about it this way. As a borrower, you are a borrower, they are the lender. They are going to lend money, and the more risk that they take, the higher the cost of the rate of that mortgage has to be, right? Because they're taking a bigger risk. Risk, reward. The higher the risk, the higher the reward they want. Does that make sense? I hope it does. So let me give you some specific examples of risk versus reward. For example, a 30-year mortgage is a higher risk loan because there's more likelihood that you'll default within 30 years. They can't project 30 years out what might happen to that loan. But a 15-year mortgage is a shorter period of time, and they have a little bit better guess of what might happen in the next 15 years. So a 15-year mortgage has a better interest rate than a 30-year mortgage. Apples to apples. So that's something to consider. Consider a 15-year mortgage. Another thing that really impacts interest rate is your credit. Your credit score is a determinant factor of how well your interest rate is going to be. The better your credit, the less likely you are to default on the mortgage. So again, better credit, better interest rate. Another factor is how much down payment you're giving. The more of the down payment you're giving, the less of the risk the lender's taking. On a $100,000 home, if you're putting 20% down, they're lending you 80%, $80,000. The home's worth $100,000. They only lent you $80,000. If you don't pay on that mortgage, they take the property back. They have a lot of equity there, and so they get covered by some of that risk. Whereas if you borrow 95%, not so good. A little bit higher risk, and you're going to get a higher rate. So those are just some of the basics to consider, and how you could adjust how good of a rate score you might have. So if you have 20% down, you have great credit, and you're getting a 15-year mortgage, you're going to get a lot better rate than someone who has got marginal credit, who's putting 95% down, and who is doing a 30-year mortgage. Make sense? So if you have any other questions about this whole mortgage business, I'd be happy to answer your questions. Comment below or find us on our website at stratwellrealestate.com. I should make sure it's clear that I'm not a mortgage broker. I do not originate mortgages. I help people find and sell homes. That's what we do. But we do have a good base of real professional, real skillful loan officers that we've worked with over the years, and we'd be happy to put you in touch with them if that's something you're interested in. You can find our information at stratwellrealestate.com and look for our contact information there. It's all there. Email, phone numbers, text, whatever you need, you can reach us. That's it for the video. If you thought that was helpful for you and would like some more information like this, please take a moment now to subscribe, share this video with somebody else, like and comment, do any of those number of things, and we'll see you at the next video. Thank you. Have a good day.